Good morning, all.
Morning, Bob.
As you can see, I'm distracted trying to find our PowerPoint slide here. Hold on, get going. Do that. Come down to here. Sorry, I didn't have this racked up already. Come on. All right, I think we're good. Hello, everybody. Good morning. We're ready to go into chapter 6. So we've done one chapter a day, 3 chapters a week. And what I'm thinking is we'll go through what are called closing journal entries today. And that means that we've gone through the entire accounting cycle. Whether you're a small mom and pop store or a huge corporation like General Motors, it's the same thing. You record transactions and you prepare a trial balance at month end. You adjust the trial balance and you use it to prepare your financial statements. You publish your financial statements, take a deep breath, and then you prepare what are called closing entries, which is what we're going to look at in a moment here. Monday, I think we can use, it's a holiday, but I intend to be here if anybody wants to join me and have a review for the test and get you all set up. And I know how difficult it is going through this material so quickly. So let's see what we can do with closing entries. I believe is the subject here. Closing entries, financial statements in the closing process. And we talked about the worksheet, that 10-column worksheet. We use it to prepare the adjusting journal entries and the financial statements. And now we have to prepare what are called closing entries. Learning objective 1, prepare financial statements with the aid of a worksheet. Well, that's what we learned in chapter 5, that 10-column worksheet. You start with the trial balance, you adjust it, new trial balance, and from that you can prepare first the income statement and then the balance sheet. And the sequence of the financial statements is quite important. And this always seems to pop up on the test. They ask you for the order of preparing the financial statements. And we should know by now, we have to do the income statement first in order to come up with the net income to move over to owner's equity. And once we get the owner's equity, then we can substitute that on the balance sheet for the beginning capital number. And they're talking about an income statement heading, company name, statement title. What's important, the only thing important there is where it says period ended or last date in the period. An income statement covers the entire month. It's an accumulation of transactions. Day 1, you had $100 in sales. Next day, you had 200, 300, etc. You need to say period ended or the last date in the period, or you say something like for the period ending, for the year ending. And that's going to be important to understand. Revenues are shown first. We know that. Total revenues, expenses. Expenses are listed in either account number order or descending order by dollar. I've never seen, you can't do it descending order by dollar amount. Believe me, that would never work for different reasons. You do it by account number order. And net income comes out of that. And here we go. Here's our buddy. Here is our worksheet after it's been adjusted. So everything below drawing, as we know with the horizontal line, is your income statement. We have to start with that. 8,000 in sales, less, looks like about 7 or so, expenses gets us down to a profit of 44.50. 44.50. So the worksheet takes us right into the income statement. Now we have the income statement done. We can prepare the statement of equity. And this is going to start with the capital balance at the beginning. We're going to add the net income, and we're going to subtract drawings. You need to bide your time when you're doing the statement of equity. Bide your time, BIDE, beginning, income, drawing, ending. So the capital from the worksheet may not be the beginning capital, only because the owner might have made some more investments, okay? This statement uses the net effect from the income statement. Instead of showing revenue increasing and expenses decreasing the owner's equity, this statement uses the net income from the income statement. As we know, revenues increase equity, expenses reduce equity. It's just that we don't make that entry every day. We wait until the end of the month and gather up the net income and then move it into owner's equity. And drawing are the personal accounts. And after this chapter, I don't think you're going to see the word drawing again. Well, here's our statement of equity. Statement of equity, you got to bide your time. You start with the beginning, which is $5,000. You add net income, subtract withdrawals, and you come up with a new equity. Withdrawals are not an expense. They are not an expense. They don't impact your income statement. A withdrawal is a reduction in the company's equity or net worth. Forms of balance sheets. Liabilities are shown below, or you can do them on the left. This is nothing I think we need to worry about. Report form, they're just saying you can show the assets and then below the liabilities and equity, or show the assets on the left and the liabilities and equity on the right. Classified balance sheet. I'd like to introduce a new term here. Classified balance sheets. Similar items are lumped together. Assets are classified as current assets, or what they're calling property, plant, and equipment, fixed assets. Current assets, you're hearing that term, I think, for the first time. A current asset is any asset that is expected to be used up within a year. Current assets are your cash, accounts receivable, inventory, and prepaid expenses, okay? Those are your main current assets. And as we go through the course, you're going to see that current assets are used in a lot of measurements of the company's viability. Just like you have current assets, you have current liabilities. Current liabilities are liabilities that are due within the next year. Current liabilities due in the next year. And your current liabilities are going to be accounts payable, wages payable, taxes payable. It could be notes payable if the note is less than a year. Otherwise, it would be long-term liability. So we're going to do a lot of comparisons of current assets, current liabilities, and do some measurements. Current assets. Assets that will be converted into cash or consumed within a year. Cash, AR, inventory could be there, and your prepaids. And they talk about
Bob, real quick, it's not showing on your screen.
Oh, for heaven's sake, I was worried I would make that mistake.
No worries.
Oh, God, thank you. Thank you, thank you. Ugh. Man, oh man, I went the whole semester without egg on my face. Thank you. Good morning, everybody. Welcome to the class. I am so sorry.
No worries. There we go. That looks good.
There we go. All
Thank
right.
you.
Okay, I'll briefly go through this again with the visual. With the visual, we talked about the worksheet. Prepare financial statements with the aid of the worksheet. We do the income statement first, the statement of equity second, balance sheet comes third. Income preparation at the on the header, you must say for the period ending or for the month of or something like that. What you cannot say is as of. The as of or at is reserved for the balance sheet. Revenues are shown first. Income statement. Here they were talking about showing them in account number order and descending dollar order, which is ridiculous. Here's what I thought I was showing you a few moments ago. There's the worksheet, all adjusted. Here are the sales, $8,000, delivery fees, minus the expenses, gives you a net income of $4,640. Okay. Statement of owner's equity. Here we go. And this is kind of where we're leaving off, I think. The statement starts with the capital balance at the beginning of the period, plus the income, minus the drawing. And let's take a look at the statement of equity. You have a beginning of $5,000, which you see there. We add the net income, 4,640, and subtract the $3,000 in withdrawals. So this business grew from $5,000 to 6,640. That's pretty good. That's like almost 23%, something like that. And then we're talking about the forms of the balance sheet. I'm not that worried about this. You can put the assets on the left side of the page, liabilities and equity on the right, or you can do them vertically. It makes no difference. And here we go again. Current assets, those are assets that get chewed up within a year, used up within a year. Current liabilities are those that are paid within a year. Current assets, cash, accounts receivable, prepaids, and inventory. Current liabilities are going to be wages payable, accounts payable. Current assets, cash, receivable, supplies, prepaid insurance. Okay, now here's where Justin mercifully saved me from messing this up forever. Here we go. Operating cycle. They're just pointing out you start with cash, huh? You start with cash and you do something with it. You buy supplies and services. You provide services or sell your product, collect receivables, and back to cash. Cash to cash. Property, plant, and equipment. These are called fixed assets. Assets that are expected to serve the business for many years. Also called plant assets or long-term assets. The most common definition is fixed assets. Land, buildings, equipment, vehicles, things like that. These are your big ticket items that are going to provide benefits for a while, for a number of years, which you can then depreciate with an adjusting journal entry. Current liabilities, this thing's kind of bouncing around a little bit. Liabilities due within a year. They'll be paid with current assets, of course. And they're giving you a couple of examples. Accounts payable, wages payable. Any accrual is a current liability. Taxes payable, always a current liability. Long-term liabilities, obligations that you're not going to be paying within a year. It's not going to require the use of current assets. Long-term debt, a good example is a mortgage. You go out as a business and you buy a piece of property and you take out a mortgage on it, say a 30-year mortgage. Well, the first year that's due on that mortgage is a current liability. The remaining 29 are part of your long-term liability. You borrow money from me, I loan you $1 million today, and the deal is you don't pay me back for 10 years. That is a long-term liability on your part. You're going to have to pay me interest, though, every year. Balance sheet preparation. Current assets are listed first, and that's going to become very important. And then you have your fixed assets, the property, plant, and equipment, and the accumulated depreciation account. And then on the liability side, you start with the current liabilities. The capital account does not show net income or drawing. What they're saying with that is, we are not going to show anything but the one capital number at the end of the month. We're not going to separate the net income on the equity statement, nor show the drawing. The drawing is the personal business of the owner, has nothing to do with the public's need to know. We just bring over one number for capital. And the balance sheet must balance, And here we're looking at the balance sheet relationship to the worksheet. So here we have our famous worksheet, the final trial balance, and we know we now have to do the statement of equity. Statement of equity. So what was the beginning number for equity? You get it right here from the trial balance, $5,000. That's your beginning number. We had net income, which we figured out was $46.40. Add that, subtract the withdrawals, and we're down to $66.40. Now that we did the equity statement, all we have to do is copy every number here on the balance sheet, except two things. We're not going to bring the drawing over. We're just going to show the new capital number, which is $66.40. The closing entries, which we're leading up to, are those entries that are going to zero out the net income into capital. Additional investments by the owner, we know that. Okay, I guess they want to make a big deal of this. Additional investments by the owner, they appear in the general ledger capital account or part of the unadjusted trial balance. Here's all they're talking about. Ramon Balboa had capital at the beginning of the month of $5,000. But during the month, he invested in another $3,000. That $8,000 balance appears in the unadjusted trial balance. That's all they're saying. Statement of owner's equity with additional investment. He had $4,000 at the beginning of June, and then he had some net income withdrawals. So at the end of June, his capital balance was $5,000. We bring that over as the beginning balance for July, and here is where he put in an extra $3,000. So they're just showing you had 5 plus 3 is 8. And then he had income again. He had withdrawals, bringing the balance down to $98.50. $98.50. Journalize and post closing entries. Closing entries will be easier to prepare if you understand why we are doing them, okay? We have permanent accounts and temporary accounts. Permanent accounts are the balance sheet items. Assets, liability, and capital. Those are considered permanent accounts. We don't close them at the end of the month like we do with the revenues and expenses. So permanent accounts represent the balance sheet. Assets, liabilities, capital. You never close them, okay? Everything else is a temporary account. What are the temporary accounts? Revenues, expenses, and drawing. These are the ones that have to be zeroed out. And I keep using that phrase zeroed out for a reason. They get zeroed out into capital. So that at the end of the month, when you open up for the next business month, you post your closing entries, the balance in all the income statement accounts and expenses will be zero. They will be zero because you took that net income impact and moved it into equity. So we close the revenues and expenses. The closing process, it gives temporary accounts zero balances so they are prepared to accumulate for next month. And you're going to use a clearing account you're seeing for the first time called income summary. Income summary account is used to aid in the closing process. And here are 4 steps, and these are really good 4 steps. This is a pretty good couple of slides coming up. Step 1, close the revenues. How do we do it? Revenues have a normal credit balance, as you now know. So what we're going to do is we're going to debit all the revenue accounts. You might have 3 or 4 of them, or you might just have 1, but we are going to debit the revenue accounts to bring them to zero. And we're going to credit our temporary account called income summary. So at that point, the income summary contains the revenues. Step 2, close the expenses. We know expenses have debit balances, so we're going to credit all the expenses, zero them out. So at that point, the income summary equals your net income, okay? Now we're going to take that number in the income summary and we're going to debit it, hopefully debit it. We're going to take the balance in the income summary because it represents the net income, credit balance, hopefully. We're going to debit income summary to get rid of that and credit owner's capital. Be the opposite if it was a loss. Step 4, you close the drawing directly into capital. You debit capital and you credit drawing. That's all there is to it. Okay. So these are your 4 steps: close revenue, close expenses, close the income summary, which now has the net income in it, close the drawing. And they're giving us a little visual here. So here's what we're doing. We have owner's equity, and we're going to go to the revenue. We're going to debit, see that? We're debiting with a closing entry, the revenue, and that revenue goes into the income summary. We're going to credit the expenses, and that goes into the income summary. So now the net income is sitting in that income summary, which we then move, hopefully, to increase the owner's capital. Drawing, that just requires a debit to owner's capital and a credit to the drawing. Okay, I mean it's that finite. There's not a lot to it in terms of the closing entries, but it can be a little hard to fathom, why we're doing it. Why we're doing it? We're updating the equity. Okay. Not going to worry about that slide. And here we go. Let's look at it in the general ledger. Let's see what we have here. Well, we'll start with the revenues. He had only 1 revenue account, so he debited that for $8,000 and credited income summary for $8,000. Put the sales in. Then he went through every expense and credited every expense. Look at that. The balances are all zero. We add those expenses up and they came to $33.60. That left a balance of the expenses rather were $46.40, and it left a balance which we then close out, and the drawing gets closed directly to capital. Directly to capital. Closing entries. Yeah, no, in my world, when I was working, you go through the closing process and you'd be working hard to prepare the statement, everything gets done. And then you take a deep breath and do the closing entries. These could be done without any real time pressure, like the other parts of the closing. Let's look at it in journal entry form. This is what you got to understand, huh? Capital is going to be increased by net income. We're going to take the delivery fees, which have a credit normal balance. We're going to debit that. Credit income summary. We're then going to credit each individual expense and debit income summary for the total. So our net income is now sitting in income summary, which we can now get rid of with a debit and a credit to Mitchell Capital. And we got to get rid of the drawing. That means a debit to capital and a credit to Mitchell drawing. Okay. So that's a quick look at the closing entries. Okay. Once you practice them a little bit on your homework, it shouldn't be too bad. Prepare a post-closing trial balance. Well, this is the final thing I guess we're going to publish, although I don't know anybody who ever looks at it. Prepare a post-closing trial balance. It's prepared after the closing entries, after you zeroed out all the revenues and expenses. So you are not going to see any of the temporary accounts on the post-closing trial balance. All you're going to see is the balance sheet. And again, the only thing this trial balance does is prove debits equal credits, okay? So our post-closing trial balance looks like this. Notice it has the assets, liabilities, accounts payable, wages payable, and capital. Post-closing trial balance. And on the test, they like to slip in a couple of questions regarding the post-closing trial balance. True or false, rent expense would be seen on the post-closing trial balance? The answer is no, it's an expense. Same thing with revenues. Steps in the accounting cycle, Lee. Well, we've kind of gone over this a little bit, but what do we do during the month? We get source documents, we get pieces of paper, we get emails, we get texts, we get memos, we get notes of conversations, anything. It could be a cash, cash register tape. It could be a purchase order, a sales order, an invoice, whatever it is. It kind of jogs us into a transaction. We analyze these documents, these requests, and we prepare the journal entries, and we post them to the general ledger. The month comes to an end, and we know that the trial balance we just prepared is incomplete because it lacks the required adjusting journal entries that all companies do. So we're going to take that trial balance with that big 10-column worksheet, and we are going to prepare the adjustments in the next 2 columns. And then we're going to complete the end of the worksheet, and we're going to use that to prepare the financial statements. We're going to post the adjusting entries, prepare the statements. Then we do the closing entries in the post-closing trial balance, huh? Cash flows, I'm going to go into this appendix briefly. We might pop a question or two on the cash flows. What I'd like you to just get into your skull a little bit is cash flows. Cash, it means cash coming into the company, cash coming out. If you're looking at a company that is throwing off profits, but they have lousy cash flow, be very careful. There's some kind of mismatch. 3 kinds of cash flow: operating, which is the good cash flow. That means you're generating cash from selling your product. You're generating income by doing what the company was set up to do. okay? You have another kind of cash flow, investing. You go out and you buy stock in another company, or you buy a big fixed asset. And then you have financing, which is borrowing money. So the only thing I'd like you to remember on this is the three types of cash flow: operating, investing, financing. And they're giving you some examples here. Mitchell Williams invested cash, financing, obviously. He purchased a big piece of equipment, investing. Purchased delivery equipment on account. Well, at that point, there's no cash at all. And he's paying back a loan. That would be financing. And they're giving you a few more here. Received cash for delivery equipment. That's as operating as you can get. Paid cash for June. That's a normal operating expense. Paid the phone bill. Made deliveries on account and bought supplies, operating. So you get the idea here. So operating cash flows, investing cash flows, financing cash flows. Just have those three terms in your mind, okay? And at this point, we have come to the end of our chapter. Anybody have any questions, any comments, any ideas for us? Anybody, Justin?
That looks pretty good.
Okay. All right. Well, just thanks for straightening me out at the beginning, Justin. I'm going
Yeah,
to try
no
to,
worries.
I may or may not edit the tape to take that embarrassing start out, but we'll see. But anyway, Monday is a holiday, and we're really, supposed to celebrate Memorial Day. But I'll be here at 9 o'clock for a review session for the exam that I hope will be very useful. And then, of course, you got the tutoring sessions before the test, and we'll get you prepared. Okay, guys? We'll talk to you later. Have a
All
good
right.
weekend.
Take care, Bob. Thank you so much.
Thank you, Justin. Good night,
Thanks.
everybody.
Take care.